Hello and welcome to my new channel, Accounting with Sandra. My name is Sandra and I'm an accountant and lecturer, and I'm hoping to help students and those with a keen interest in accounting and taxation to understand accounting and taxation concepts with videos in 5 minutes and under. In this video, I'm hoping to explain and clarify the concept of audit assertions. So let's begin. What are audit assertions? Australian Auditing Standard ASA 315 within paragraph 4 defines assertions as per the very wordy definition on screen. In simple terms, assertions are the statements that management and those charged with governance make about the financial statements that they have prepared. As auditors, we look to detect misstatements by assessing whether these assertions are indeed valid. So let's consider what these assertions are, bearing in mind that there are two different types of assertions, those which relate to the balance sheet and those relating to the income statement, and then bring them back to this definition. As an auditing lecturer, I can say with confidence that students always get confused on the assertions that relate to the balance sheet and those that relate to the profit and loss. I cannot emphasize enough that you need to be very careful in your assessments when selecting your assertions, as they do differ between the two financial statements. So let's start with the 6 assertions relating to the balance sheet. Existence. This assertion is the claim made by management that all the assets, liabilities and equity showing on the balance sheet actually exist. This assertion is more so targeted at asset balances, as it's in the best interest of management to show higher amounts of assets at year end. So for example, an entity discloses that they own 10 buses. The assertion of existence implies that all 10 buses actually exist. Rights and obligations is the claim made by management that they hold or control the rights to the assets shown on their balance sheet, or they do in fact have an obligation to repay the liabilities disclosed on their balance sheet. So that is, they claim to hold 10 buses, then those 10 buses must be legally owned by the entity. Or in terms of a liability, they may disclose a loan on their balance sheet, then the loan documentation would show that the loan is indeed in the name of the entity. Completeness, that management have included all assets, liabilities and equity items as required. Although this assertion mainly relates to liabilities, as it's in the best interest of management to show fewer liabilities than more, it can still be applied to asset accounts. So for example, an entity has 4 loan balances, then all 4 should be recognized as a liability at year end. Valuation and allocation, that management have included all assets, liabilities and equity items at the correct values. So for example, the accounting standard that pertains to inventory requires inventory to be recorded at either the lower of cost or net realizable value. This assertion suggests that the value of the inventory showing on the balance sheet is therefore either at the lower of cost or net realizable value. Classification is management's claim that all assets, liabilities and equity have been recorded in the correct accounts. This is of significance for the balance sheet when considering the distinction between current and non-current assets and liabilities, and also considers whether the debits and credits have been posted into the correct accounts. And lastly, presentation. Management's claim that all disclosure requirements as per each of the individual accounting standards have been met. Now let's shift our focus to the 6 profit and loss assertions. As you'll see, although some of the assertions are given a different name, they have the same meaning, and this is where students often get confused in their assessments. Occurrence is management's claim that all transactions and events recorded have actually occurred. This assertion is mainly concerned with the potential for the overstatement of an entity's revenue, which would be more favourable for management as it would lead to a higher profit. So for example, an entity has sales of $1 million on their profit and loss. Did the entity in fact have $1 million worth of sales transactions during the year? Completeness is management's claim that all transactions which should have been recorded have been recorded. Again, this assertion is mainly concerned with the understatement of expenses, which would be more favourable for management, with lower expenses resulting in a higher profit. Accuracy, that all transactions have been correctly recorded. So that is, sales invoices have been correctly recorded in the sales ledger, or if we're dealing with foreign transactions, the amounts showing have been correctly translated. Students tend to get accuracy and valuation and allocation assertions confused. Although they do essentially have the same definition and mean the same thing, their names are different between those accounts on the balance sheet and those accounts on the profit and loss, so be careful. Cut-off is where management have included transactions in the correct financial year. So that is a sale that may have occurred in the days after the end of financial year haven't been pushed back into the financial year that we are auditing, and expenses that have occurred in the financial year we're auditing haven't been pushed through into the next financial year. Classification, that all transactions have been posted into the correct account. So for example, rent expenses have been debited to the rent account and not to payroll. And presentation, which is also concerned with disclosure requirements in the financial statements. These will be all discussed as we discuss all the relevant accounting standards going forward from here. So now that we understand the different audit assertions, my video discussing audit procedures will link how we test these assertions when conducting audit testing.